Why is it that most of us can use and love innovative products and services daily, yet have little opportunity to invest in the companies behind them? Imagine using Uber, Airbnb, or Snapchat regularly, but not being able to invest in their success because they're private companies. This disparity highlights a significant barrier: the wealth gap in investment opportunities. Today, we'll delve into how this gap has widened and explore solutions to democratize investing, ensuring that everyone can participate in wealth creation. So without any further delay, let's get started. The private investment dilemma. The private investment dilemma lies in its exclusivity, where only accredited investors, typically the wealthiest, can participate. This restricts access to lucrative early-stage opportunities in companies like Uber or Airbnb, limiting wealth creation to a privileged few. The shift towards private markets further consolidates wealth among those already affluent, exacerbating the wealth gap. Addressing this dilemma requires reforms to democratize investment access, ensuring broader participation and equitable distribution of economic opportunities. The frustration of exclusion. The frustration of exclusion stems from the inability of ordinary investors to access promising investment opportunities in private markets. Companies like Uber and Airbnb offer substantial returns, but only accredited investors can participate, shutting out the majority. This exclusion perpetuates wealth concentration among the already affluent, widening the wealth gap. Addressing this frustration demands reforms that democratize investment access, allowing all investors, regardless of wealth, to participate in economic growth and wealth creation opportunities. The access barrier. The access barrier in investing lies in the requirement for accredited status, which limits participation in lucrative private market opportunities to the wealthiest individuals. This barrier excludes everyday investors from early-stage investments in high-growth companies like Uber or Airbnb, where substantial wealth creation occurs. Overcoming this barrier entails regulatory reforms that broaden access, enabling more diverse investors to engage in these opportunities. Democratizing access can help mitigate wealth inequality by allowing broader participation in economic growth and innovation. The Uber case study. The Uber case study illustrates the wealth divide in investing. Early-stage investors, mainly accredited, capitalized on substantial gains as Uber grew from a startup to a global force. However, everyday investors were excluded until Uber's IPO, which promised broader access but often resulted in initial losses. This case highlights the challenges of wealth concentration in private markets and the complexities of democratizing investment opportunities. IPO, the wealth transfer moment. The IPO marks a pivotal moment where private wealth shifts to public markets, ostensibly broadening access to investment opportunities. However, it often reflects a wealth transfer skewed towards early, accredited investors who benefit most from initial price surges. Everyday investors, eager to participate, may face volatility and initial losses. This moment underscores the dual nature of IPOs, democratizing access while presenting risks that challenge broader wealth distribution and inclusion in financial markets. The shift from public to private markets. The shift from public to private markets denotes a trend where companies increasingly opt to remain private longer. This strategy, driven by regulatory burdens and market dynamics, consolidates wealth among accredited investors and institutional funds. While private markets offer flexibility and capital access, they limit public participation in early-stage growth and wealth creation. This trend highlights a need for regulatory reforms to balance investor access and market transparency for a more inclusive investment landscape. The impact of regulations. The impact of regulations on investment markets is profound, influencing accessibility and wealth distribution. Stringent regulations intended to safeguard investors often inadvertently restrict public access to lucrative private market opportunities. This regulatory environment favors accredited investors and institutional funds, exacerbating wealth disparities. Reforms like the Jobs Act's regulation crowdfunding aim to democratize investment by lowering barriers. Balancing investor protection with market access remains crucial for fostering equitable wealth creation and inclusive economic growth. The changing company mindset. The changing company mindset reflects a shift away from traditional IPOs due to regulatory burdens and a preference for private funding. Companies increasingly prioritize flexibility and strategic growth in private markets, where they can secure substantial capital without immediate public scrutiny. This shift challenges the historical notion of IPOs as a gateway to broad investor participation and liquidity. It underscores the evolving dynamics where companies balance growth aspirations with regulatory complexities and investor demands. The problem with IPO excitement. The problem with IPO excitement lies in divergent investor expectations. While the public anticipates opportunities to invest, insiders often view IPOs as opportunities to cash out. This discrepancy underscores a systemic issue where wealth creation from innovative companies primarily benefits a select few. The IPO, once a symbol of democratized investing, now symbolizes a moment of conflicting interests, highlighting the need for reforms to restore alignment between public market access and investor expectations. The growing wealth gap. The growing wealth gap is exacerbated by the shift of wealth creation from public to private markets. Limited access to high-growth private investments primarily benefits accredited investors, widening the disparity. This trend reduces opportunities for broader wealth accumulation and economic mobility. Addressing this gap requires equitable reforms that enhance public market access and democratize investment opportunities. Balancing regulatory oversight with inclusive market participation is crucial for fostering a more equitable distribution of wealth. A solution: regulation crowdfunding. A solution to democratize investment opportunities is regulation crowdfunding, Title III of the Jobs Act. It enables everyday investors to participate in private company investments, historically restricted to accredited investors. By allowing companies to raise up to $5 million annually from a wide pool of investors, regulation crowdfunding promotes economic inclusivity. This approach mitigates the wealth gap by empowering individuals to invest in innovative ventures, fostering broader wealth creation, and enhancing economic equity. How regulation crowdfunding works. Regulation crowdfunding, Title III of the Jobs Act, allows small businesses and startups to raise up to $5 million annually from individual investors. Companies must disclose financial information and comply with reporting requirements, but the process is less burdensome than traditional IPOs. Investors can browse platforms to find opportunities, contribute funds, and become shareholders in promising ventures. This democratized approach to fundraising opens investment avenues to a broader audience, fostering innovation and economic growth. The power of the crowd. The power of the crowd in regulation crowdfunding lies in its ability to democratize investment opportunities. By pooling small contributions from individual investors, it enables broader participation in funding innovative startups. This collective support not only provides crucial capital for growth, but also validates market demand and fosters community engagement. It empowers everyday investors to play a significant role in shaping the future of promising ventures. Closing the wealth gap. Closing the wealth gap hinges on expanding access to investment opportunities through regulation crowdfunding. This regulatory framework enables individuals, regardless of wealth, to invest in promising startups. By democratizing access to wealth creation, it addresses systemic inequalities and fosters economic inclusivity. This approach empowers diverse communities to participate in and benefit from entrepreneurial ventures, thereby contributing to a more equitable distribution of economic prosperity. In addressing the wealth gap through expanded access to investment opportunities, improved financial literacy, support for small businesses, affordable housing initiatives, and social safety nets, we can create a more equitable society. By empowering individuals with the means to build wealth and fostering inclusive economic growth, we pave the way for a future where prosperity is shared by all. Together, we can bridge the divide and ensure that everyone has a fair chance at financial success. Thanks for watching. If you found this information valuable, don't forget to like, share, and subscribe for more insightful content. Until next time, take care and keep striving for economic empowerment.